and the cash flow of the industry starting from. Okay, somebody's asked. Yes, I can record it, of course. We said engineering economy is everything about how money is being utilized, how money comes into the industry, what can we use to manufacture our products and to build the industry itself. So everything about the industry, the bigger picture of the industry, is known as engineering economy. It deals with engineering economy. Okay, somebody's chatting again. My voice is not clear, so I guess this is another problem. Can you hear me now? Is it okay now? Is it okay? Can you hear me? Okay. Okay. Said everything about design of the industry, how to plan it, how to invest, what to invest, what kind of materials we will use to manufacture, how to build the industry, how to market our products, and the kind of profit we'll be getting for this industry. Everything about it is engineering economy deals with it. And we said the decision making process in engineering economy involves understanding the problem itself to define the objectives, collect all relevant information, define any alternatives if you have them, and then you identify the criteria you want to use in decision making, and then you evaluate the alternatives and apply sensitivity analysis to see if you change this kind of parameter, how will the other one change, and so on and so forth. After you do that, then you select the best alternative and you implement the alternative and monitor your result. We even give an example of a Mazda and Honda. If as an industry, if you want to lease a car for your employees or for the use of the industry, what kind of car will you go for? We said you define an alternative. You said you need a car with mechanical stability. Then you gather all the technical and financial information regarding these two cars, and then you choose one of them, and then what you want to know, what you want to have is the criteria of decision making. You say, okay, I want a car with high mechanical stability but at minimum cost. Then you select which car you want to apply sensitivity analysis and see if actually this car is saving more money for the industry or not. Then we move ahead. We said engineer everything about this. You deal with it as an engineering economist. Now we started defining what is an alternative. We said an alternative, which is just like an English word. It is another choice for something. You have two things, and this is an alternative for the other, for this thing. Like a phone, we said an alternative of Samsung, maybe it's an iPhone, and so on and so forth. So in the engineering economy, an alternative means things like purchase cost, anticipated useful life. I mean, how long this kind of product will cost, and how much, how long a product B will. I mean, how long a material A will cost. For example, you want to buy a building material for the industry, for your industry. Then you say, okay, I can go for a brick, or I can go for this kind of material. So let me see which one will last longer, and then maybe you'll think about the yearly maintenance cost, how much you will spend to maintain this kind of building, also the operational cost, and then maybe after using this kind of car for the industrial day-to-day activities, how much I will resell the car so I can regain some amount I saved on the car. Yeah, I invested on the car. And also you put interest rate into consideration. We said cash flow is the inflows, how much money comes into the industry and how much money goes out of the industry. This is known as a cash flow. And then equivalence is clear to everybody. Then we say in what form cash will come into the industry. You said you sell your products, that is cash sell, then you get money for the industry. Then you sell maybe the furniture of in the industry or the assets of in the industry. Then you get money into the industry. Interest bank grants, if you get grants from somebody or from an organization. Share capital investment, if somebody decide to invest into your industry, then cash is coming into the industry. And then cash can go out of the industry in form of a salary, payment of tax, payment of loans or supplies, that is buying some supplies into the industry. In cases where cash outflows is greater than cash inflows, then you have negative cash flow. if the amount of money that leaves the industry is more than the amount of money that comes in the industry into the industry, then maybe you'll be running a bankruptcy. Yeah, so you have a negative cash flow. For positive cash flows, we said when cash that goes out of the system is less than the cash that comes into the system, then you have a negative, positive cash flow. So you will have profit in the industry. We said a cash flow diagram will look like this with some arrows. Some arrows will be facing down, while some arrows will be facing up. The ones that are facing down, they are indicating cash outflows. So cash is going out. It's usually represented by an ink of red or something like this, depending on the organization. While cash arrows that goes up or point in the upward direction are incoming cash into the industry. So this graphical representation on time scale is known as the cash flow diagram. Time value money, that is a dollar you receive today plus the profit you make will be equal to the dollar you make in the future. That is a dollar you receive today worth more than a dollar you receive tomorrow, because you can invest and then get some money on top of it. So the difference in value between money today and the money in the future is called time value of money. Okay, time value of money. This can come out in your exams, so or your quiz, so you should be able to remember it. Okay, so today we'll be looking at an important aspect, that is interest. Although it has some calculations in it, we might not look at the calculations today, because as I told you, this slide is written. I mean, it's somebody made the slides, so they are not my slides, and the way the calculations are represented, I really did not like the way it is represented, so I need to come up with my slides also. So they only informed me about this course, that I will be taking this course a week ago. So I didn't have enough time to prepare my own slides. But next week I will prepare this slides. I mean, I will make the slides better so we can start the calculations. But for now, let me introduce what is an interest. You all know what is an interest. I mean, you pay. You rent a car, or you get a car from any dealer, or you get these days electronics even from Jarir or somewhere else. So if the amount of the electronic today is 1,000 reals, then they will tell you that you'll get the electronics at some percentage increase yearly. So that percentage is known as an interest rate. So at the end of the month, maybe you are supposed to pay the whole money in 1 year. So if you sum up the money you pay, will be a little bit above that 1,000 reals, maybe 1,100 or 1,200 reals. So that 200, that is the difference between the initial money you buy, that they sell this kind of iPhone, maybe 1,000 reals in the Jarir, and the sum of money you paid at the end of the day, the difference will be the interest rate, or the interest. That is the 40 reals difference will be your interest that you pay to the company. So interest, the display of the time value of money. So time value of money, how you display it is known as interest rate. That is the fee that one pays to someone else money. So you get some money from somebody, or you get a property from somebody, and then at the end of the day you pay like a fine, or some money in addition to the capital, the main money you received from that person. So you get initially, he gave you 100 reals. Then when you are paying him at the end of the day, you pay him after 1 year. And then at the end of the day, maybe you pay him 120 reals, $120. So that money that you pay him, the additional 20 reals or $20, that is what is referring to this interest, the fee that one pays to someone else money. It is also the difference between an ending amount of money and the beginning amount of money. I said this before. The difference between the ending amount, that is at the end you are paying $120, and then the beginning you took $100 from him. So the difference, that is $20, is interest. So all these are different ways you can define an interest. So interest means amount owed now. That is the amount you owed now, the amount you are supposed to give this guy now, minus the principal, that is the initial money you took from him, is known as interest. Okay, or the end amount minus the original amount is known as interest. End amount, that is the amount you owed now, minus the original amount, that is the original money you collected from the guy, is known as interest. Now, sometimes you'll be talking about interest rate. That is, this is interest rate or rate of return. It's all the same. So interest rate paid over time period is expressed as a percentage of principal. That is interest rate or interest rate of return in percent. That is equal to interest accrued per time unit over the principal. That is the main money, the main capital multiplied by 100 is the interest rate. There are two types of interest rates. There is a simple interest, that is interest that is calculated using principal amount only, and then a compound interest, an interest that is based on principal plus any interest that you incurred. That is interest compounds over time. So in simple interest, the formula for calculating simple interest is the principal amount of money, that is the main money you collected from the guy. Example, you collected 100 reals today, the multiplied by number of periods times the interest rate. So maybe he's giving you at 5% interest rate. So you multiply it by the 5% over the time, multiplied by the time, multiplied by the number, the amount of money you take. Okay, so this is another formula, total due of money that you give back after some years. We'll look at these two formulas in details next class, and then when we look at them, we explain them, then we'll go into the calculations, and then you'll see some examples on how to calculate interest rates, and how to calculate the original money that you have spent and that you collected when given your interest rate, then the amount of money that you owed now, or maybe when you're given time and so on. So we'll look at all these things. Next class, I will prepare a better slide that I can use to explain this kind of concepts to you guys. So that is it for today. It's almost time. Do you have any question? I can still upload this, but I would prefer to update the slide before introducing it to you. Okay, so next class we will look at all these calculations and the better explanations for this interest, simple interest and compound interest, and then I can give you some example on how to do the calculations. Okay, so question. Okay, if there is any question, if no question, then we call it a day. Nice weekend. Okay, thank you all. So thank you all. Have a nice weekend. Yes, you leave. Thank you too, guys. Thank you, Nasser, Sahib, yeah, Abdul Majid. Okay, thank you.